Hi there. Now we will continue our presentation about the last topic, which is liquidation in partnership. And I hope you remember the key points that we should cover in the strategic in the liquidation. First, we sell the non-cash assets, and whatever loss or gain we get from this transaction, we distribute it among the partners by the ratio. We usually get it in the example. And then we need to pay the creditors first, which we call them outside debt. And then we pay the partner's loan, which we call it inside debt. And the remaining balance we distributed among the partners. And we had a few examples where we discussed the statement of realization and liquidation, which can show us in steps the balances of the assets and liability and equity after every transactions. And then we had journal entries to validate what we made in the calculation. In this exercise 6, where I stopped by in my previous presentation, it's talking about journal entry only. And to give you a quick recap, that here is a company that has two partners, Albert and Barb, and both of them, they decided to change the partnership into a corporation. And what happened is that they have, like here, 3 assets. They would like to reevaluate it before they move the company from partnership into corporation. And they need to close off all the accounts of the partnership, and they need to create a new journal entry for the startup of the corporation. So here, let us take the first one. We have accounts receivable, we have inventory, we have equipment, and the book value for the accounts receivable, inventory, and payment is here. Okay, but the fair value of the accounts receivable, as you can see them here, it shows 23,300, the inventory 34,500, and the equipment 41,100. So this can tell us that all the assets, they have loss in their valuation, and we can tell that the accounts receivable had 800, inventory 3,200, equipment 7,200. So a total loss of 11,200. How can we distribute the loss as we did in the previous example? If you can see here, Albert will take 60%, Barb will take 40%. So we take it here, this one times 60 will go to Albert, and here times 40, which will go to Barb. And we need to make the journal entry. So when we make a loss in the asset, it means the asset will become debit by those balances. Sorry, credit. And when we reduce the capital of the partners, we put them debit. And this is what I put here in the first journal. So here you can see the loss that happened to the 3 assets, receivables, inventory, equipment, and the division of the loss between Albert and Barb, as you can see them here. So now we did the first journal, the valuation. Second, we need to transfer the assets from the partnership to the corporation, which they call it Epic Corporation. So how can we make the transfer? When we make the transfer, we don't transfer the book value anymore, but we transfer the fair market value. So those assets, we start from here. Cash, 10,000. Then we take the fair value, not the book value here, for receivables, inventory, equipment, and then we close off the accounts payable. So the accounts payable here by 22,000. The issue is because we are closing off the accounts, all the assets will be credit to close off the debit, and the liability will be debit to close off the credit. And this would make the second journal entry. So here we see we credit cash, receivables, inventory, equipment by fair value. We debit accounts payable and the investment in Epic Corporation for the balance. How do we get the 86,900? It's the total credit minus debit, we get the balance. So this would be the second one, the transfer of the assets. The third one, we need to close off the books. So how can we close off the books? This debit account should become credit. And now we closed all the assets and liabilities in this journal. So the only journal or the only account is still open, this one, Albert and Barb. But we know that we made losses that was distributed to Albert and Barb by those amounts. So here, Albert was debited by 67.20 and Barb was debited by 44.80. So how much is the net capital of Albert and Barb? Here you go. So what we need to do is debit those accounts to close them off, credit the investment account to close it off, and this would be the third journal entry. So here you go. So we debit investment by 86,900, credit Albert and Barb, and from where do I get this one? As you can see them here. So we get the original capital minus the loss, original capital minus the loss, and this would give me the third journal. The last journal, now we sold the assets, recognized the loss, made the payment, closed off the account. We need to start up the new corporation, which is here, number B. How can we start the new corporation? Like what we did in the previous chapter. How we start a partnership? We put all the assets debit, all the liabilities credit, but in partnership, we put capital. In corporation, we put common stock and additional paid-in capital. How much is the common stock? It says here, $10 par and a total of 7,400. So if we multiply it, it will be 74,000 because you multiply the number of shares by the par value. And here would be the journal entry. So we debit cash, we debit accounts receivable, we debit inventory equipment by their fair value. We credit accounts payable, but here we multiply $10 times 7,400, and the difference between the debit and the credit will go to additional paid-in capital. And this is the whole example. The final example in this chapter, exercise 7, it talks about 3 partners, Paul, Emma, and Terry, and they share their percentage of loss and profit by 2 to 1 to 2 1. So we can make it like this, 2, 1, 1, a total of 4. So 2 over 4, 50%, 1 over 4, 25%, and here also 25%. And now they sold the assets of the company for $111,000. And now we have the trial balance, as you can see here, the cash, receivables, inventory, equipment, accounts payable, and their capital. We don't know anything about other issues, except they sold the assets for 111. So what we need to do, we need to check the total amount of the assets here. So if I make their total and subtracted 111, we get 49,500. That's fine. And now I have cash 7,100. And we already have cash here from the sale, 111,000. So the total amount of cash will be 118,100. What does he need in this example? We need to do the cash distribution plan. But here we will come across something that we didn't discuss it in the previous example, which we call it loss absorption potential. How much loss each partner can take based on their initial capital. What does it mean? We know from the balance sheet that Paul had 66,000 capital, Emma 56, and Terry 35. And their percentage of sharing the loss or revenue, 50% to 25 to 25. That's fine. Now, how much Paul can absorb as a loss if any loss happened to the company? Since his ownership is 50%, he can take as much losses as it is 66,000, his capital. So how can I get the loss absorption? I take his capital divided by his ownership percentage. So we take 66 divided by 50%, we get 132. Then we get 56 divided by 25%, 224. The same thing for them. So how we get the loss absorption? We get their capital and divided by the ownership percentage. You can tell that now Paul can take less amount of absorption, 132. Why? Because he has big ownership percentage. Emma, she has big capital, but less ownership. So she can absorb more losses than Paul, and of course, Terry can absorb more losses than Paul. Now, as if we need to make the loss absorption percentage equal. So what shall we do? We go by the highest. This one is the highest loss absorption portion or potential. So we subtracted here 224 from the lower one. So we have 224, then 140, then 132. So you go from the highest to the second highest. And then this would be Emma. So Emma, if you subtract 224 minus 140, we get 84. So now if I take the 84 and multiply it by 25%, I get the actual loss that Emma can absorb, 21,000. So now Emma's capital will be reduced by 35,000. And you say, what am I supposed to do with this 21,000? I will come down here in the payment cash, and I will show you what we should do with it. But let me continue before I leave this table. Now I have Emma and Terry at 140 LAP, and Paul has 132. So I need to reduce the LAP, the loss absorption potential, from Emma and Terry to be equal with Paul. So let us subtract 140 minus 132. Each one of them will give me 8,000. And then we take 8,000 times 25%, we get 2,000. 8,000 times 25%, we get 2,000. Then we subtract it, we see the second LAP will reduce Emma's capital to 33 and Terry's capital to 33. Now, we said that we have cash of 7,100 and we will make a sale of assets for 111. So if we add them together, we get 118, 100, which I explained it here. The total of these two numbers will give me 118, 100. So first we said in the cash, we need to pay the liabilities. How much is the liabilities here? Accounts payable, 10,600. Then the remaining balance after this deduction should go to Paul, Emma, and Terry. But because Emma, she has higher LAP than both of them, she will take 21,000 first. And this is the reason I put the 21 here, I put it. But still, Emma will take 2,000 and here 2,000. So I put here 2,000 Emma and 2,000 Terry. And then the balance will go between Paul, Emma, and Taylor. And this would make it a total payment of $41,250 for Paul, $43,625 for Emma, and $22,650 for Taylor. I hope you find those two short videos are useful to explain what we need to do in the liquidation of a partnership. Thanks again for this course. And again, remember to take a few minutes to complete the course opinion survey for advanced accounting and any other course you take with me this semester. Thank you. Bye.